All right, why don't we go ahead and get started? So lots of activity behind me. It's, I guess, nice to not be in the office alone for once. But anyway, today we're going to talk about valuing shares. So spend some time in a PowerPoint. We'll go to a spreadsheet, very exciting. And then, of course, answer any questions anyone has. But first, a couple housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I obviously cannot offer personal advice. If you're over in New Zealand, you can go to our website, morningstar.com.au, and you can get a copy of our FAP. And then also, if you are in New Zealand or anywhere and you would like personal advice, you can go consult with a financial advisor. All right, so let's get started. So obviously, I would love any questions. So there is a Q&A function. You can throw them in the chat. One other thing, if anybody wants to do this twice in a day, we have a webinar tonight on passive income. It's how to build a portfolio that can generate passive income and just some things to look out for. We're interested in that. We had to delay it an hour, so it's at 7 p.m. Sydney time tonight. So if anyone's interested in that, sign up for it or send me an email if you don't have a link for that. All right, so let's get started. I don't know what that is. All right, so there we go. That's what I didn't know what it was. All right. We're going to talk about how to value a share today. So we'll get into a spreadsheet. We're going to go through a discounted cash flow model. But first, I want to spend some time talking about a relative valuation technique, what relative valuation techniques are, because I want to draw a distinction between how you actually value a share and then, of course, how you can compare share valuation levels to other things. All right, so we've got a little definition on here of what we're looking at. So relative valuation technique involves comparing standardized metrics. We'll get into what that is, peer groups. So you're comparing it to something else. And then, of course, this perception that they have value. Okay, let's go through each one of these elements. So an example of a relative valuation technique, which we'll use as we walk through here, is the price to earnings ratio, or the PE ratio. So we'll use that one as an example. So number one, how do we standardize that metric? Well, we standardize that, of course, and the metric that we're looking at when we're trying to look at the relative valuation of a share is the price of the share. So how do we standardize that? We standardize it by earnings. And it's an important concept that I think a lot of probably mostly beginner investors do miss. The fact that what you are buying when you buy a share is earnings, the price of a share. So just the price level of a share has nothing to do with anything. So whether a price is a share is trading for $100 or $1, it is irrelevant. All that's relevant is what we are getting when we go out there and buy that $100 share or that $1 share. And one of the things you're getting is earnings. And so a lot of these relative valuation measures, so whether we're looking at book value, which is basically assets minus liabilities, if we're looking at cash flow generated by the company, if we're looking at earnings, those are the things you get when you buy a share. So, of course, a share is an ownership stake in a company, and we care how that company does. So the price that a share trades for is irrelevant. What matters is what you're getting for it. So that's how we standardize metrics. That's how we standardize a price. We compare it to something. That's a price to earnings ratio. So all you're doing is comparing the price to the earnings, basically just dividing the two, and you come up with that price to earnings, or PE ratio. So standardized metrics is the first thing. The next really important thing to say is whatever that metric is, whether it's a price to earnings ratio, a price to book value, price to cash flow, once again means nothing on its own. Is a PE ratio of 10 good or bad? It depends. You have to compare it to something. That's why we talk about comparing to peer groups. Now, there's a couple of different ways that you can compare a PE ratio, for example, or any one of these metrics. You can, of course, compare it to a different company, and we'll get into some of the pitfalls around that. So you could say company A is trading at 10, PE ratio of 10. Company B is trading at a PE ratio of 20. Can make that comparison. You can compare it to a historic return or historic PE ratio. So company A is trading for 10 times earnings. 10 years ago, it was trading for 20 times earnings, or its average traded for 15 times earnings, trading for 10 now. So you can compare it to different historic measures. And then you can also compare it to something like the market, right? And you can say the P ratio of this share is 10, the market P is 20. So in that case, it is cheaper than the market. Now, we don't know if that's good or bad, but at least that's the comparison. Now, when I talked about comparing it to different companies, there's a couple things to take into account. And this is an important thing for all relative valuation techniques, is they can't be looked at in a vacuum. Because what investors are willing to pay for earnings has all sorts of different factors that investors will factor in. A simple one is the growth. How fast is a company growing? You should pay more for companies that are growing faster. That just makes intuitive sense, right? If you're buying earnings, what you're buying when you're buying a share is future, and what the company will earn in the future, you should buy something for, you should spend more on something that's growing faster. So it's very hard sometimes to just compare the PE ratio between different companies without actually doing an analysis and understanding why there would be differences. So that's one important thing to look at. The other important thing to look at is if you're comparing very different companies, it's not going to be very effective, right? Different industries have different characteristics. Different types of companies have different characteristics. So it's very hard to compare a technology company, for example, with a oil and gas company. And the reason for that is because just the business model and the economics of those two industries are very, very different. So just to go through that example, technology companies, as we often talk about, have generally higher margins. They're very scalable, meaning that they can grow that company with less assets. And as they continue to grow and get new customers, they don't have to invest as much into the company. Where something like an oil and gas company is a very asset-heavy company, because you have to go find the oil, then you have to set up all the infrastructure, then you have to take the oil from wherever you pump it to where you refine it, and you have to move it to wherever you sell it. All of this stuff takes a lot of assets. So it's harder to scale a company as effectively, because every time you want to increase something like output, you need to invest a bunch in the company to do that. You need new ships and pipelines and refineries and everything else to deal with that. So it's very difficult to compare different companies. And that's another reason that relative valuation techniques are not great. So just make sure that those companies are very, very similar. Sergey says, hi. Hello. Oh, now he sent a question. Yeah, he's talking about how to understand price to cash flow in terms of financial valuation. Yes, we're going to get into that. I promise. Once we get into the PowerPoint. All right. What we're going to spend our time doing today is we're going to look at a discounted cash flow model. So this is the way that you value a company. So P ratio, everything else, like those can be interesting metrics that you might want to use when you're starting to look at a company. But the way you value a company is a discounted cash flow model. And it's the way you value basically everything. It's the same concept. Whether you are at work and you're proposing an investment, you are going to use something very, very similar, right? You're going to look at what this costs and then what you're hoping to get out of that in the future. So let's talk about what this is, and then we'll go through some detail in Excel, which is always fun for everyone. All right, so what are we doing? We are valuing a company. Let's look at the name of this, a discounted cash flow. Let's start with a cash flow. So how are we valuing this company? We're valuing this company based on the cash flows that it will generate in the future. And that's a very, very important thing. I said this earlier, but anytime we buy a share, anytime we become an owner of a company, we take an ownership stake in a company, all we care about is the future. Just like if you were to go out and buy your own small business, all you would care about is what that small business did in the future. So that's why we're focusing on that. But there is an important principle with investing called the time value of money formula. So the time value of money formula says that $1 today is worth more than $1 in the future. Now, what do we do about that? So we're not just going to project cash flows into the future. We also have to bring them back to the present day to find the value of the company today. So we're discounting them as the discounted part of a discounted cash flow model. All right, why don't we just get into this? Let me see if I can find, all right. So we built a bit of a spreadsheet here. So let's start with what we're projecting into the future. All right, so anytime you are trying to value a company, you are estimating what that company is going to generate in the future. Now, obviously the future is unknowable. So how do you do that? How does one of our analysts here at Morningstar do that? Well, what they're doing is they're obviously looking at the past. That's why we do look at financial statements. We do look at how companies have operated, and we're using that as a basis to then estimate how they'll do. So start with that. We need to, of course, look at all the different things that would impact a company. So that could be the general economic environment. It could be the industry that they operate within. It could be looking at their customers, looking at the inputs into whatever good or service they're producing. We need to look at all of these factors, of course, where we're trying to figure out what happens in the future. And that's really what our analysts do here at Morningstar. And the notion behind fundamental research is really understanding that company and the industry they operate within. So anyone who was on here on Tuesday, of course, saw Matt and Angus, two of our analysts, and hopefully saw from the way they were talking about the different companies in their coverage universe that they do have this deep understanding of strategy of the company, the environment the company is operating within, the different forces that are impacting that company, right? We spent a lot of time on Tuesday talking about iron ore prices, because of course, if you're going to look at miners in Australia, there's BHP, Rio Tinto, Fortescue, et cetera, you need to know what iron ore prices are going to be, because that's a huge input into the cash flows they'll generate in the future. Now, we're making a very important distinction here with cash flows. We are looking at cash flows and not earnings. Now, there's a couple different reasons for that, but let's talk about what those two things are. Earnings are something that is based on accounting regulation, accounting rules, on how we calculate earnings. So what we're doing when we calculate earnings is we are using something called accrual accounting. And what accrual accounting is basically trying to put a bunch of rules in place to make sure that whatever is generated from earnings during a certain period is reflective of what was actually earned in that period. So here's a couple examples of how accrual accounting works. If you prepay for something, a company does not get to book all that revenue. So for example, what I encourage all of you to do, if you take out a Morningstar premium subscription, you pay for it when you take out that subscription, and then you have a subscription term. So whether it's 1 year, 5 years, et cetera, we don't book all of that as earnings right when you pay, because we still need to deliver you a service over the next 12 months. So in that case, if you gave us, to make this very simple, $120 for a subscription, it does cost more than that, unfortunately. You gave us $120 for a subscription, we don't recognize all of that immediately. So accrual accounting tells us we need to recognize it over the period when we are providing that good or service. So in that case, it's over 12 months, $120, so we recognize $10 a month in revenue. Same thing on the cost side. So we, of course, want to match costs up with revenue. So accrual accounting tells us that even if we go out and buy a new computer that has an expected life of 2 years, what we're going to do is we're going to recognize that cost over 2 years. It's not going to be a huge earnings hit the minute you purchase that computer, because we're going to use it for a while. So that makes sense when we're looking at earnings, of course. The other thing that happens with earnings is we have things called non-cash charges as we are making all of those different adjustments. So examples of a non-cash charge is depreciation. The example I always use for depreciation, because I think it makes sense, is that if we look at Qantas, for example. So when Qantas goes out and buys a plane, they are not going to take a giant hit to earnings that year to buy the plane, because the plane has a long useful life. That plane may last 10 years, that they'll use it over 10 years. Now, the way accounting works and the way that is, the way that's treated on accounting statements is the plane would be an asset that would sit on the balance sheet, and then we would depreciate that plane over its useful life. So once again, if the plane costs $100 million and we think it lasts 10 years, that's its useful life. $100 million goes on the balance sheet. Every year we depreciate $10 million off of that plane till it's at zero at the end of its useful life. Now that $10 million is a non-cash charge to earnings. So instead of having $100 million right up front, we would have a $10 million hit to earnings every single year, because that plane, of course, is a cost of doing business. So that's accrual accounting. If we look at cash flows, if we look at cash flows, that is simply looking at what goes in and out of the door. So very simple, like the same way you probably manage your own finances, is that money goes into your bank account, it goes out on various things. As cash goes in and out, that is actually what's happening. So when Qantas buys this plane, they would pay $100 million, assuming they pay cash, which they probably wouldn't, but they would pay $100 million, but then there'd be no cash that would go out the door for the rest of the time. Now, as investors, we want to focus on this cash flow, because cash flow, many people would argue, is just a much purer representation of what is actually happening with a company. All right, so how do we do that? What we need to do is we look at revenue. So revenue is, of course, sales. And then we're going to look at earnings before interest and taxes, and we'll talk about why we don't include those in a second. We are going to then look at all of these non-cash charges. So depreciation is one, amortization is another one. Amortization is writing off a basically intangible asset. So like goodwill or something like that. So goodwill occurs when you buy companies. For example, we'll go into all the differences, and we want to get down to this free cash flow. So other things that we want to look at is capital expenditures. So that's something that you could spend a lot of money on something in 1 year that is not necessarily recurring. So we're trying to break this down to what is, when we look at free cash flow, what is the company actually earning every single year. So if you look at this formula, what are we doing? We're adding back in depreciation and amortization. So we're adding back in those non-cash earnings charges. We are then looking at working capital. We're subtracting working capital. That's basically what the company needs on a day-to-day basis to keep the lights on. So basically, think of working capital. I guess an example for people would be like money you keep in your wallet, maybe, if anyone carries money anymore, uses money anymore. And then we want to take away capital expenditures as well. Because that capital expenditure is something that we are building, that we are spending to maintain this business. All right, so we come up with free cash flow, and that's what we want to look at. So what I've done here is I've just obviously made all this up, but just projected out free cash flow over 10 years. And that's great. Okay, so now I have the next 10 years. I've done my estimation. And of course, to do this does involve a lot of detail. And understanding, as I said, the company, the industry, everything else. All right, so what am I doing now? Can I just value the company off these cash flows? No. Remember, this is a discounted cash flow model. So I need to discount these back to the present day. So first, let's start with the discount rate and what we're going to use to discount those. So at Morningstar, we use something called the weighted average cost of capital. So the weighted average cost of capital basically is how much it costs the company to fund itself. And a company can fund itself through two different ways. It can go out and it can raise debt. So debt could be a bank loan, debt could be issuing a bond, or it can raise capital with equity. That is selling ownership stakes in the company. So that's what happens when a company originally goes public. And that's what happens if there's a secondary offering, for example. Now, I know we're getting a little complex here, but yeah, keep the questions coming, and I will get to them. So, all right, we've got two sides of this. Debt is easy. It's easy to come up with the cost of debt, and the reason it's easy is because it's observable. So if a company has issued a bond, no matter what they issued the bond at, I can go out and observe in the market what the cost of debt is. The cost of debt is an interest rate. So if I am Coca-Cola and I want to see what my cost of debt is, all I have to do is go find a bond that I've issued and see what interest rate it's trading at. And that represents the cost of debt. So that's really easy. Cost of equity is different and a lot more complex. And a lot of people, people use lots of different things to calculate that cost of equity. So they could use something called the capital asset pricing model, which is very complex, which which we won't get into. They could use more of like an equity risk premium. So that is, once again, difficult to calculate. At Morningstar, we basically very simply come up with 5 different costs of equity, and those are based on the riskiness of the company, so the uncertainty in the company. So that's what we use as a cost of equity. Now, in many of the analyst reports, they will list out their weighted average cost of capital. And that will just be in the analyst report. So I've used a figure of 10 here, so 10%. Now, one important thing that is going to become obvious is one of the big inputs into a weighted average cost of capital, of course, is the level of interest rates. Because the way that bonds, for example, trade is that bonds will trade at a premium to a risk-free rate based on a lot of different factors, but mostly around credit risk. Right? So if I take a risk-free rate, the rate where I know I'm going to get paid back as a bondholder, then I have to assess the riskiness of a company and see how much more interest I will demand to compensate me for the risk of that company going bankrupt and not paying me back. What that basically means is, in general, as that risk-free rate goes up, then all of a sudden, that overall discount rate is going to go up. Right? So when we hear stuff like the Federal Reserve, which they came out overnight and said that they may raise interest rates next year, which is, of course, accelerating this, that will raise the discount rate that analysts use to calculate something like this discounted cash flow model. So that's why we care so much about interest rates. That's why lower interest rates make shares worth more, and we'll go through this in a second. That's why higher interest rates make shares worth less. And the reason that's true is because if you think about a discount rate, right, the higher the discount rate, the more we're discounting those future cash flows, the less they are worth today, right? A lower discount rate means that they're worth more today because we're taking less of a discount. So that's what I've done across these 10 years. So if you very simply, for those of you that like Excel, what I've done, if we look at the formula, I've taken this cash flow 10 years in the future, and I have taken this weighted average cost of capital, and I've discounted back by the amount of years. So I've discounted back 10 years. That's all I've done. And I've done this for each one of these cash flows just to demonstrate what we're doing. We, of course, could create a formula that just did all of this. So I've discounted them all back. So what this means is the $253,000 that we estimate this company is going to earn in 10 years is worth $97,000 today. And we can keep going back in each one. So you see, obviously, when I discount it back less years, then all of a sudden, I'm just taking a 10% haircut. All right, so hopefully that makes sense. We've discounted all of those back, and we've added them all together. So now we have a total value of the company. They're probably sitting there saying, well, wait a minute, what happens after 10 years? And of course, that's a great question. The thing about a company is a company, in theory, lasts in perpetuity, right? There is no ending to a company. A company could go out of business, a company can be bought, company can merge with something else. Like, these are all scenarios that could happen, but there is no end to a company. In theory, a company will just last forever, as long as it's not purchased or goes out of business or anything else. So we, of course, need to account for things that happen after that 10 years, right? Because we'd be leaving a lot of potential value on the table if we didn't do that. Now, the problem, of course, and we're getting some questions around this, which I'll go through. So the problem, of course, with predicting the future is that it's very, very hard because the future is unknowable. I don't think any of us could have predicted what is happening, what has happened in 2020 and 2021. None of us could have figured that out at the end of 2019, for example, right? The future is unknowable. The further out we get into the future, the more unknowable it is, right? And we all know this around our own lives. Maybe I can tell you what I'd be doing next year. It's very hard for me to figure out what I'd be doing in 10 years. So yeah, that's just a fact. So there is a limit to how far out in advance an analyst can and should make estimates to what's happening. So generally, people will go out between kind of 5 and 10 years, depending upon the company. But anything past 10 years is admittedly just guessing. So how do we value what happens after whatever period we choose? If we're confident in 5 years, how do we value what happens after that period? Well, we do something called the terminal value calculation. And basically what we look at for the terminal value is we just put an assumed growth rate, in this case on free cash flow, into a model. So it's sort of a throwaway number. We're just assuming, and the way that a lot of people do this is they'll sit there and they'll look at the company versus the overall economy and say, okay, I think the economy is going to grow 3% annually well into the future. I think this company can achieve that. Or I think this company can double that, or I think this company can't even achieve that. So we come up with this terminal growth rate, this long-term growth rate. So in this example, I use 2%. And they'll grow that free cash flow 2% after that. So what does that allow us to do? It allows us to take the year 11 free cash flow, which is 2% more than year 10. And then we simply, for once again, people that do enjoy Excel, then we simply, sorry, that's the wrong number. Then we simply look at, once again, this terminal growth rate. We divide it by the difference between the weighted average cost of capital and the terminal growth rate. And there we go. We calculate that terminal value. Now remember, this is a terminal value in 10 years. So we still need to discount that back to the present day. Now I've done two calculations. So in the next 10 years, we've done the present value. We add both of them together. That gives us a total value for the company. Now, the problem with this total value for the company is that some of this we do not have a right to as shareholders, right? And that's what the debt holders have a right to. They have a right to the debt of the company, because that's what they've done by buying bonds. So what we want to do is we want to subtract that. So we're going to take that debt out, so the total debt, and we're going to add back in the cash, because we do get access to the cash. And we're going to divide that by the total number of shares. What that allows us to do is come up with an estimate for the value per share for a company. So that was probably a lot. I'm going to go through some questions now, and then we'll keep talking about this. There's a couple other things we need to do. Okay, yeah, so the anonymous attendee is saying, do the Morningstar analysts make their assumptions available, e.g. the WACC they use for a particular company? Yeah, listen, they sometimes. So what I'd say is, what they do is they will put that into their research report. So I'll find an example for you. Hold on. So yeah, oftentimes they will put in those assumptions into that report. Now, the problem is that they are, of course, analysts, so you do need to understand what they're saying. But let me show you an example. All right, so share screen. Hold on. All right, so we use this InvoCare example because Angus talked about it so much. So if you look within our analyst reports, see there's a bunch of different sections. If we go into fair value and profit drivers, this is where they oftentimes will list some of their assumptions in there. So if we look and read Angus's report, what's he saying? So he's saying he thinks sales are going to grow by 9% a year. So compound annual growth rate, 9% over the next 5 years. So he's trying to value it out the next 5 years. He's telling you where that's going to come from. So he says they're going to raise prices by 3%, and there's going to be a growth in the number of deaths per year. InvoCare, of course, is a funeral home operator. And he thinks they'll gain a little bit of market share, right? So they're taking some market share from other people. The deaths go up. That's good for everyone in the funeral care business. And the company will raise prices. So that's how they're driving, that's driving revenue. Then he's saying over the longer term, we expect aging and growing populations to boost case volumes. So that is what he thinks is going to happen over the long term, that we will continue to see growth. That probably goes into his terminal value. That's revenue. We want to look at cash flow. So once again, he's looking at EBIT, so earnings before interest and tax margin. So the margin is the difference between what something earns and then what their sales are and then what they earn. So 20% margin, that means they will keep 20% of anything they sell after we account for all the costs in the business. So yeah, that's an example of where you can go in and see the different assumptions. And up here, he says our discounted cash flow model, which what I just showed you, uses a 7.2% weighted average cost of capital. So that's an example where you can go in and find these inputs. So yeah, they're not, especially the analysts do write these reports. They will include different information in them, but that's just an example of what you can find in our report. So yeah, some of this, some of this is of course a little complex, and I'll show you one more thing that will hopefully be helpful. Maybe let me share my screen again. I don't know what's going on with my Excel, but this is a real analyst report. So this is looking at Apple. So that's, of course, what we have right there. That's the actual analyst report. But yeah, this is looking at Apple. So I sent this as somebody, for example, I pulled out a couple inputs. So it is a little more complicated than this, but yeah, those are some of the assumptions. And generally, our analyst reports have like 20 different tabs on them, full of all the assumptions that they're making. So yeah, that's an example from Apple. So someone's saying, what is an example of a 5-star? You guys are making me work today. A 5-star extreme stock. So let's see if we actually have one. I'll share my screen while I do this. Oh, now I'm lost with Zoom. All right, so what I'm going to use is I'm just going to use, once again, I'm on our website, I'm just going to use an investment filter to do that. So I add filter stocks. We don't have that many that are extreme, so I will go every single market. So if I look at valuation, I can say a 5-star stock, and then I want to look at, where did we put uncertainty? Sorry, I think I know where all this stuff is. Do we put it in here? Yeah, I want to go extreme uncertainty, see if anything fits that bill. So we're going through 47,000 different shares, no results found. So maybe if I take off that 5-star, we can start to see some extreme stocks. So I don't know, just go, we'll go every category. All right, so here's some examples. So we've got airlines. So airlines, obviously a little bit of a tricky business model, not great businesses. What was that Buffett quote? Like how to turn a big fortune into a small fortune. You invest in an airline. So a lot of airlines, some resources companies. So these are examples of things that are rated extreme. Now we only have 10 companies out of the 1,600 that we cover that are rated extreme, including some drugs. Cannabis. So interestingly enough, yeah, 3 of the 10 are airlines, a couple in the oil and gas sector, 3 in the oil and gas, drug manufacturers, and somebody selling weed. So yeah, you think the demand for weed would be pretty good, but maybe that's if you're just selling it on the street. So those are examples of extreme companies. So we do have a question, will the recording be available afterwards? I missed most of it. Yeah, so it will be available. So we will put this up on YouTube. So if you just look for Morningstar Australia YouTube, there's a playlist on there for all of these that you want to go to. So it will be available. Anyway, all right. I'm going to finish this up because I have 2 more webinars today and 2 podcast recordings. So yeah, busy day, as I said. But anyway, thank you guys for joining. If anyone does want to join at 7 o'clock, we're going to talk about passive income. It'll be a little less technical than this and hopefully interesting. We'll see how we go. But anyway, thank you guys very much. And send me an email if you have any questions.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.